Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, I'm Ravi Singh. Welcome to another edition of our weekly podcast, The Week That Was. Global markets concluded an eventful last week. The RBI surprised markets with an off-cycle policy action on Wednesday, citing increased risks to inflation amid ongoing geopolitical tensions and a reasonable growth recovery. It raised several key policy rates, notably the repo rate by 40 basis points and the cash reserve ratio by 50 basis points. Later the same day, US Federal Reserve raised target policy rates by 50 basis points, in line with market expectations, and announced further that quantitative tightening will start from June. On Thursday, Bank of England raised the base rate by 25 basis points in the third consecutive policy meeting. Indian assets came under pressure following RBI's surprise action, as both domestic and US bond yields continued to rise. Crude oil prices rallied further, and foreign investors sold in both debt and equity markets. The Nifty index was down 4% over the past week and underperformed most regional peers. The broader markets underperformed Nifty over the past week. Among sectors, all sectors except utilities ended the week in the red. Pharma, telecom, autos, and realty fell the most with cuts of over 4.8% over the past week. The US equities had reacted positively to US Fed's policy announcement as US Chair Fed Powell took 75 basis point rate hike off the table. However, the one-day relief rally was followed by 2 days of heavy selling as investors remained concerned that Fed's need to maintain an aggressive policy stance to tame inflation remains, hurting growth outlook. The Indian bond market weathered one of its toughest weeks over the recent past. Government and corporate bond yields rose across maturity following RBI's surprise policy action, with the short to medium maturity yields rising higher than the longer maturity. The 10-year Indian government bond yields closed at 7.45%, up 31 basis points over the week, while the 3-year and 5-year Indian government bond yields rose by 71 basis points and 44 basis points respectively. The INR rose initially post the RBI's policy announcement. However, it came under pressure later in the week as the USD index rose, touching a 2-decade high followed by a rally in the crude oil prices and foreign investor sell-offs in domestic equity and bond markets. The INR closed at 76.93, down 0.7% for the week. In our earlier podcast, What Moved the Markets, my colleague Vinay Joseph discussed the implication of RBI and Fed rate hikes for investors. He discusses that investors should brace for higher volatility as the market adjusts to higher interest rate scenario and tighter liquidity, with inflation likely to remain above RBI's upper bound target of 6% in the first half of fiscal year 23. Bond yields face further headwinds from an unfavorable demand and supply balance and the absence of incremental support from the RBI. However, a sharp rise from current levels is unlikely as government bond yields are factoring in 75 to 100 basis point repo rate hike over the coming 12 months. On the macro fundamentals, little has changed as India's economic growth in the coming year is expected to stay above trend amid still supportive policy environment as policy rates are not restrictive enough for equity markets yet. Further, earnings growth expectations, the main driver of equity returns in the mid-cycle, remains robust. Ongoing earnings season and policy rate expectations are near-term drivers. Consensus expects Nifty earnings to rise by double-digit for the 7th straight quarter. Better earnings delivery is crucial for market returns. Investors are likely to watch for any shifts in interest rate expectations for the RBI and the US Fed. At this point, I'll take a pause and thank you as always for listening.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.